Excellent. Well, I'm going to kick us off this morning. So a big warm welcome to our event this morning called SME Finance, the next chapter. My name's Jordan Berg and I'm a business manager for SME Finance, and I'll be your host this morning. So thought I'd take the opportunity to give you a little bit of a background of SME Finance and why we gathered you all here today. So SME Finance is the Southwest leading CDFI. So for those of you who aren't familiar with what a CDFI is, what it stands for is Community Development Financial Institution. But what it means is our purpose is to bring social and economic benefits to people, places and the business community in the Southwest. And we do that as a gap lender. So we provide access to finance for SMEs and entrepreneurs who have been unable to secure their requirements from mainstream lenders. So as you'll be aware, the SME finance landscape changed quite dramatically over the last few months due to COVID. If someone had said we'd all be running around saying things like sibbles and bibbles, you'd probably think they'd lost their mind. However, as a lender and an accredited delivery partner for CBILS, we are seeing firsthand the devastating effect that COVID is having on schools. It's a topic that's close to our hearts, and that we felt with some of the government-backed financial incentives due to come to a close, now was a good time to bring together some leading industry experts who represent a diverse range of perspectives, reflect on the year and sort of speculate over what might be needed next for the future of SME finance. So a bit of housekeeping before we get started. All of today's attendees should be automatically muted and cameras disabled. So if your camera or sound is on, please can you mute yourself or switch it off? I can't see anybody, so that's fine. It's not that we don't want to see your beautiful faces, but we want to keep the best quality streaming and, to be honest, want to retain some sort of order and control in this morning. I should also let you know that this session is being recorded. So if you would like a copy of today's webinar, please get in touch with us by email on info@swigfinance.co.uk. We will open the panel to some Q&A throughout the session as well. So we want to hear from you, our attendees this morning. And you can submit any questions using the Q&A box at the bottom of your screen there. And I'll do my best to bring them in as and when I can. So the agenda this morning, well, it's split into two parts. Firstly, we reflect over the last sort of 6 to 7 months, hear about some of the challenges our panelists have faced within their organisations, but also in the communities in which they serve. And then secondly, we'll look forward around the sort of virtual Zoom style table and share some opinions on what might be needed next to support the continued recovery and future growth of SMEs. As I mentioned, there'll be opportunities for questions throughout, but I'll tend to pose these at the end of each section when each panelist has had a turn to speak. But please just post them as you go, and I'll be sort of collating them and ordering them for when those opportunities come in. So a great big welcome and a big thank you for our amazing panelists for joining us this morning. I will just go around and quickly introduce them. And each of you, if you could wave your hand when I call your name, as I don't know if some of you have noticed, we've got a few Pauls and a few Johns, so it'll be very useful. So in no particular order, we've got John Peters, Managing Director of SME Finance. Thank you, John. We've got Lydia Samuel, Entrepreneurship Lead for ACH, Refugee Integration Services Provider. We've got Paul Jones, Senior Manager, UK Network Team Southwest at British Business Bank. Paulo Collins, Head of Innovation for Business West. Paul Hanford, Communications Director for Resonance Limited. And John Field, Commercial Banking Director for Metro Bank UK. So I'm going to kick off this morning with Paul Jones from British Business Bank. Now, Paul, it'll be interesting to hear about some of the data that British Business Bank has been collecting through this time. What insights you might have for us, general scheme uptake, trends, success rates, those sorts of things, and maybe how these vary across different sub-regions within the sort of England Combined Authorities sort of region. Okay.
Yeah, certainly. Thank you. And good morning, everybody. Really good to speak as always. When we go back to sort of March and that day when we launched the scheme, it would be true to say it was launched very quickly. I think we got the state aid on a Thursday and launched it Monday. and then went through a number of iterations, including the adding of Beebles. We sit here today with 52.65 billion lent to 1.2 million SMEs. So I think, you know, immensely proud of all the delivery partners, immensely proud of everybody in the UK that's pulled together to actually get that funding out to save and help so many businesses survive. While we talk about that, we'd also talk about the startup loan scheme, which we've seen actually double in size over the last 3 or 4 months, as I suppose many people are going through and taking opportunity to start new businesses. So I just bring that in. Really coming down to the Southwest itself, we've been very successful in. We have around 10% of SMEs for the country, and we've got 10% of CBILS funding and about 9% of the BIBLES funding. So the Southwest has been able to access the funding, which is really great to see, and hopefully so many businesses come through. Where we've actually seen that, though, if you break it down, west of England itself, or the Bristol area, has seen a higher percentage of CBILS taken, slightly less BIBLES, but that's been particularly around our stronger ecosystems: Bristol West, Bristol South and East, and Bath. And then when we go out to more where more small SMEs sort of survive, around coastal areas, Western-super-Mare, for example, we've seen quite a drop-off in CBILS, but higher amount of BIBLES, which probably reflects the type of businesses. And then for industry-wise, we've seen the retail and hospitality take the lion's share, which is probably no surprise, followed closely behind by construction and manufacturing, which are all strong within our region. So I'm really proud to actually share that the money's been getting out to the right places, and the industry a little bit more we can probably do as we move forward to help more survive. Thanks, Jordan.
Thanks for that, Paul. I'm going to move on to John Field at Metro Bank now, if I may. So John, I mean, I understand it's been a challenging time for the banks, and you had to adapt very quickly to new schemes and overwhelming demand. Would you share a bit about what it's been like for Metro as an organisation, and share any of the key challenges, I guess, you've had, and also any general market observations?
Yeah, good morning. Thanks for inviting me today. I think the challenge for us as an organisation, as a bank, really was that obviously we had to adapt quickly to bring these schemes in. The CBILS scheme was actually quite an easier transition for us, because as a bank we were already part of the government's EFG scheme, and there are similarities in both schemes. So we were used to providing finance through the old EFG scheme. The bounce back was more of the challenge for us, because we at the time were not initially approved for that, and it took a bit of time for us to get approval. But then actually when we adapted our systems, built new systems, the system worked really well, and there's been a huge demand for bounce back. Since both schemes launched, we've lent now over £1 billion to Metro Bank customers. We took the decision at Metro Bank to provide the loans to existing customers only. What I noticed was we were getting a lot of requests from other bank customers. Certain banks that were not part of the scheme were approaching us and asking us for their help. We took the view that we would support only our existing book, and what we've done is we've supported over 25,000 customers now across CBILS and the bounce back scheme. So I think it was in the early days it was a bit of a culture shock. It was adapting as quickly as we possibly could. CBILS was fine. Bounce back took a little bit of time, but actually, it's working really well.
Thanks, John. I'm gonna take it over to John Peters now at SWIG Finance. So, SWIG was one of the first accredited lenders for CBILS. So, as part of your answer, it'd be great to hear about, I guess, your take on the market since scheme's inception. Also, bounce back loans came a bit later and encapsulated a lot of the smaller business market, which SWIG traditionally caters for. So, John, it would also be interesting to hear about how SWIG's adapted to ensure the support but you provide reach as many business owners and entrepreneurs as possible.
Thanks, Jordan. Morning, everybody. Yeah, so SWIG was previously an EFG provider. So in the same way that Metro transitioned directly from being an EFG provider to a CBILS provider, we did that very quickly. So, you know, it was really a case of signing the contract on the Saturday night and launching the scheme on the Monday. What we did find certainly in the first week or two was there's absolutely massive demand. We were absolutely inundated with applications. A lot of that was to do with the fact that not all of the banks had the systems in place or hadn't joined the scheme at that point. So we were receiving applications from all around the country, and a lot of the time people asking for amounts far in excess of what we were able to offer. So at that time, we were lending loans typically between 10 and 100,000, which is a CDFI was our sort of historically so our natural sweet spot in terms of the amounts available. And we put our first loans out in April, built up quite a head of steam, and then of course in May. And we knew something had to give in terms of unblocking capital and servicing the huge demand for small businesses. Bounce back loans came along. What that meant for us, obviously, is that a lot of our pipeline disappeared overnight. We had to look at the applications that we'd approved, and quite a lot of those were subsequently refinanced through bounce back loans. And while that was happening, like all other organizations, we were rapidly transitioning our own business offer and going to a home-based business model, working online, etc., and implementing an entirely online process, but very much backed by the sort of personal support that we provide as a CDFI using this great technology. So in terms of the size of lending, we looked to see how we could address that, and we were able to access a new line of capital. So from July, we increased our lending size to up to 250,000. And what that has meant is that it's led to a real upsurge in activity. We're extremely busy now, and what we're experiencing is quite a lot of small businesses have successfully accessed a bounce back loan. And quite rightly, that's been an easy access, cheap form of finance for people to access, but they've subsequently not been able to access the CBILS loan due to the application of their bank's criteria. So very busy on the CBILS at the moment. I think they both Bounce Back and CBILS have been very successful in getting capital out into the market. And the other thing I'd also like to flag is, I think Paul mentioned the startup loan scheme, which we're very heavily involved with. We're seeing a real upsurge in entrepreneurial activity, and as the economy restructures itself, people setting up in business. We've actually expanded our startup team in response to the demand. We're currently supporting on average 2 new businesses every single working day, so extremely busy. So overall, yeah, great time, great change in adaptation. And opportunities ahead.
Brilliant. Thanks, John. I'm going to go over to Paul Hamford now from Resonance. So for those who don't know about Resonance invests for social impact and specifically in social enterprises. So Paul, how have the organisations you support coped and sort of adapted over the last 6 to 7 months? And also, what role have grants and financial interventions sort of played in supporting them through that?
Thanks, Jordan. Morning, everyone. I guess, unlike commercial businesses, social enterprises have faced a kind of unique challenge during the pandemic. They had a surge of demand for their services and obviously falling incomes. If you look at demand, has come from, increasing homelessness, or we were aware of mental health issues that arise, things such as domestic abuse. So social enterprise and charities supporting those individuals have seen this massive kind of surge. At the same time, their income's fallen. There's a survey by pro bono economics months ago, saying 90% of charities saw a fall in income and 70% have seen an increase in demand. So off the back of that, it's been tough. There has been help. Everyone's mentioned Civils, and there's a Resilience and Recovery Fund that is backed by Civils that is aimed at social enterprises. There was also a grant scheme that we were involved in that ended last week called the Social Enterprise Support Fund. And that fund was giving grants away between 10,000 and 300,000 to qualifying social enterprises that were affected by COVID. Needless to say, that's the demand has far outstripped the supply of capital for that. So and it's ended. So that finished last week. That went 3 waves, and that came from the Lottery Community Fund. So I guess from our viewpoint, we work with a lot of social enterprises that we've invested in, where we've had to spend interest payments and capital repayments, and kind of support them along the way. But it's an issue for social enterprise in that there's not a great deal of supply out there. There aren't many social impact investors like Resonance. Obviously, mainstream providers, sometimes reticent to invest or to lend to social enterprises because of the inherent risk, and also because their business models can be complicated and a little bit more longer term. So yeah, it's been tough, but yeah, they're a resilient bunch. But yeah, they're in a unique position of this massive demand for their services at the moment, and a lack of supply capital.
Cool. Great. So I'm going to move over to Lydia Samuel now from ACH. So Lydia, as entrepreneurship lead at ACH, I know you support business owners and entrepreneurs from refugee and migrant communities. Could you talk about some of the unique challenges that they face through this time? It would be also interesting to hear about their sort of general attitude to finance within the community, and whether this has sort of changed at all through the.
Thanks, Jordan. So what we've seen in Bristol and the West of England region is that, no different to probably some others, is that the larger businesses are able to pivot a lot more quickly and to grow, largely because they have larger social capital and social networks. The smaller and micro enterprises have struggled considerably. Access to information and business support has actually been problematic. There's a lack of, what we found prior to COVID actually, that there has been a lack of a kind of central contact point to access the information. People desperately want help, but there is still a lack of awareness that it does exist, and critically that it exists for them as well. We have seen with our pre-start entrepreneurs some really successful pivoting. A lot of people have embraced the change, particularly e-commerce. But the micro business and entrepreneurship pertaining to the gig economy has really had a devastating impact, with immediate drops of income and many kind of relying on universal credit and food banks. So it has been particularly difficult at that end of the scale. We have seen, in terms of kind of government grants and funds and things that have been available, we have seen some uptake with local authority discretionary grant funds. There was a little bit of support needed around kind of form filling and things, just due to language barriers and written English, but we have seen some uptake for that. The key thing that I wanted to kind of raise around attitudes to kind of finance is that there are millions and millions of pounds around at the moment, but there is actually a lack of desire for the money itself from migrant communities. So we've asked ourselves the question around the kind of behaviour of the customer around the money, and the Package Act just simply hasn't been relevant for some people and some entrepreneurs. People from migrant communities really tend to prefer to grow organically or through partnerships, because it's at a risk, at a risk level that they can manage and that they remain in control of. There's a kind of quite a significant level of risk averseness within the community, so people generally aren't prepared to take large sums of money on. In respect to loans, many of the loans are excessively interest bearing, and that is a key that is a key issue culturally, religiously and socially. The reaction in interest does vary though, depending on the person, and the ability to control the amount of interest is key, as is the payback term. So I think considering things like the penalties regarding early payback, so that does all have a bearing on things. Many view debt as a bad thing. Many are educated to save instead. So what you tend to find with migrant communities is that group saving schemes are really popular as opposed to taking on loans and debts. Overall, what we've seen is there has been actually a lack of take-up in the government support schemes. Largely, and this isn't related to the British government, but this is related to many people who have been persecuted in their native countries, is that there is a fear around engaging with them. Some people do deem them too complicated to be involved in, the bureaucracy around it, and there is a feeling of it's too good to be true. And that comes down with, comes down to trust essentially, and experiences that people have had in their native countries.
Yeah, it's a really interesting perspective. Thanks for that, Lydia. I'm finally going to go over to Paul O'Collins at Business West. And Paul, as head of innovation, I understand you work closely within the sort of high growth scale-up community. It would be interesting if you could talk about some challenges in accessing finance through equity and grants through this period, and what the general feeling is amongst these businesses, which you can argue are so important for the future creation.
Thank you. Yeah, the sort of businesses that we work with, that those innovative scaling businesses, typically look at equity investment as their source of finance, to be honest with you. And over the last 6-8 months, we've seen a spectacular drop off in angel and VC investment in businesses as businesses as organisations have looked to consolidate their portfolio and understand the impact on their personal wealth of what's been happening. So what we've done is try to find alternative sources of finance for some of our businesses, because the angels and the VCs just aren't there for them. We normally have an annual pitch fest, which is getting investors and investees together in the same room, and we've delayed that because we're just not getting the sort of the positive response from investors that we need at the moment. So alternative sources of finance was key for us in terms of how can we support our clients. So we launched the Business West Finance Hub, which helped businesses look at alternative investment and alternative source of finance for them. A little bit of learning there for people who perhaps weren't familiar with some of the resources that potentially are available to them. But most spectacularly, I think we've seen a real focus on the sorts of businesses we deal with, innovative businesses in particular, looking for grants from UK government. So 2 or 3 key schemes. We've had the COVID Fast Start Response Grant that Innovate UK launched a couple of months ago now, which was a £50,000 grant scheme. Over 8,000 businesses applied to that with a less than 10% success rate. So hugely popular. And I think just measured the if you like the mood of the innovation community in terms of their appetite for grants. There's also one that's closed recently, the Sustainable Call. That was £175,000 of grant available to businesses. Again, heavily oversubscribed, and we'll be finding out results of that over the next few weeks. So again, grants are always popular. It's free money. It's not really, and there's always a price to pay for it. But we have seen a marked increase in the number of applicants who've been coming to us asking for our help and advice in how they should set about applying for and winning that grant. Many of the businesses we deal with are already existing grant beneficiaries. And the UK government has taken a really clear view on this. They put aside £750 million early on in the pandemic to support innovative businesses. They are seen as the future of the British economy. Their survival is imperative. These are businesses that have already been invested in by Her Majesty's government and the taxpayer. We don't want to see them going by the board. We've done a lot of work to try and protect those businesses and support their continuity. So they've had not only grants that have been available to them from British government, but also loans available to them specifically for grant beneficiaries. And we've been working very closely with Innovate UK at providing those businesses with a wraparound advisory support, helping them understand how their projects can be protected if some of their match funding has disappeared. And also, of course, the day-to-day problems that COVID has presented businesses in terms of resources, particularly around broken order books and broken supply chains, and the effect that's had on their particular operations. So in terms of three things, I guess four things we've been trying to do. We've been trying to provide advice on various alternative sources of finance and funding for businesses. We've launched the Finance Hub. We've been heavily supporting businesses that are looking to apply into government schemes for funding, and also helping them not only reforecast their future revenues, but also pivot their business models. And I was smiling a little earlier when Lydia said something along the lines of some of the minority communities thought this was too good to be true. And we have exactly the same thing, Lydia. It's remarkable that even quite sophisticated modern businesses who've been around the block a few times still believe it's too good to be true and have that certain degree of reluctance about engagement. But we're still out there trying.
Brilliant, thanks, Paul. Well, I'll just say to all attendees, do put your questions in. As we've been around the table on this subject, a reflective side, it is an opportunity for questions now. I've had one pre-submitted, so I will go ahead with that one, but yeah, pop them in the Q&A box if there's more further information on what people have said. But so first question is for John Field at Metro. So to read verbatim, I've seen instances of clients or directors with up to 3+ bounce back loans, one on each company with several different lenders. I wonder what the banking sector's approach would be to these clients, and requests come in for deferring payments or restructuring the loans. So John.
Yeah, thanks for that. So multiple applications. I think, obviously, personally, as a commercial lender, when I assess a lending request for a business, I need to not just assess the Metro Bank's position, but all the other debt that business has as well, because that ultimately has an impact on the debt serviceability. And I think multiple applications would probably cause us possibly a bit of concern, but that's not to say that it's wrong. There are companies that are part of a group, so a group company structure where you'll have several independent businesses within the group, and quite rightly they can apply for funding through the schemes. I think the key thing is we need to remember that these are loans, and yes, there is a 12-month period where no repayments are made. However, from month 13 onwards, this debt has to then start to be repaid. So, I think it's really important when banks are assessing this they will anyway, but certainly at Metro Bank, we really focus on the debt serviceability side of it. It's one of the key criteria to ensure that, that we're not putting the company under even more pressure. I think, COVID has created a high risk situation in effect. It's put pressure on businesses, it's put pressure on their cash position, and the CBILS and the bounce back have done a fantastic job. But we've also seen the other side of it, which has been, it's almost like, well, this is free money. And actually, particularly on the bounce back side, where the process is all automated and you don't really get challenged an awful lot on the lending, you answer a few questions, and you almost self-certify that you can repay this debt. So, you know, it is quite tempting for a lot of organizations to apply multiple times for funding. That does cause me some concern, because obviously as a banker, I'm always going to want to make sure that you can repay the debt, and that we're not putting you in a worse position. So I think sometimes you've just got to sit back and sort of look a little bit more into the future, and not just consider the current position. You've got to think, well, yeah, at some point this debt will start to be repaid. So that's where we are with it. But it's the COVID that's caused the position. It's we mustn't brand all businesses that have taken COVID support as bad. That's not the case at all. But I think Metrobank has a very strong relationship model where we keep in regular contact with our clients, and particularly as a business as usual approach. If we were lending you funding outside of CBILS or bounce back, that debt that we provide would always be closely monitored anyway, and you would have regular annual reviews, quarterly reviews. You would be producing regular financial information for us in order to keep an eye on it and make sure that it's performing well. There's been we've seen as you can imagine, we've seen a lot of different scenarios.
In all sorts, yeah.
Yeah.
Great. All right. Well, I'm going to move forward now onto the next section, and I will bring in some of the questions that we had here, as one quite nicely ties in. I'm going to bring it back to you, Paul Jones of British Business Bank. And I mean, we're all hoping we'd heard what's next by now. And finding some of the questions, it looks like there might have been a press release this morning, which I don't know if you'll be able to comment on. But what can we expect moving forward? And as we're just 1 full week away from the CBILS deadline, silver beans, what's going on?
Thanks for that. You're quite right. I think an article went out in the Financial Times this morning suggesting extension to the scheme. Our official line, and I'm told to make no comment on that report. The official line is that the scheme's come to an end for 3 future funds, CLBILS and CBILS, at the end of this month. Would pay out by the end of November, and BBILS runs until November. The article this morning suggested that the deadline for getting applications in would be the end of November for payout at the end of December. So at this point, I will say no comment, which is my official line that I'm told to take. We are expecting an announcement officially from Treasury within the next 48 hours. So watch the press, and I'm more than happy to share through you, Jordan, with this group anything that I get in the meantime.
And thanks, Paul. It's quite crazy timing for that, isn't it? Literally just before the event, there's a little bit of a leak. So thanks for sharing that somewhat political answer, but no, brilliant. Well, I'm now going to take sort of the same question around the table. And as I say, any questions that crop up, please, attendees, do submit them in the Q&A box. But really, it's just about what you feel the next steps need to be. What would you like to see as we move forward into next year to ensure the continued recovery and future growth of the business communities that you work in? So I'm going to kick off with John Peters. Okay.
Thanks, Jordan. Without knowing what the announcement's going to be in the next 48 hours, this is purely speculation. But if we can, I guess, assume that the existing enhanced guarantee schemes fall away at some point in the short to medium term, I think what we'll see is perhaps more of a market gap emerging, and I think what we are already seeing is that there are sort of more smaller and earlier stage businesses which have pivoted, restructured their businesses, looking to grow, but find that they're lacking perhaps the finance they need to do that. So what I would like to see quite clearly is some long-term capital made available to the CDFI sector, backed by an appropriate ongoing guarantee mechanism, which may not be at the sort of enhanced level of the current schemes, but provides that first loss cover that we need, because ultimately we're making unsecured lending at a higher risk end of the market. So that's what I would like to see. I think also we have to recognise that there are businesses, I think it's been mentioned, that have taken on debt which may prove to be unsustainable, whether that's because perhaps they shouldn't have taken on the lending in the first place, or I think, as is likely to be the case, there are ongoing disruptions to their particular sector, which means there are factors out of their control, which may prevent their ability to service the debt they've taken on within the agreed terms. And I think it's important that mechanisms are found to support those businesses that have longer term prospects of survival, but in the shorter term they're still faced with these challenges.
John, we're getting quite a few questions now, so I will just I'm going to zip around the table this time, but I will come in with questions after everybody's spoken. I'm next to go to Paulo Collins at Business West. Hey.
Oh, thank you. Yeah, the answer is always money, isn't it? But it's not, to be honest. There are other things as well. And I always say to any business that there are 5 things that you need to make a successful business. One is you need money, you need resources, and you need people, you need opportunity, but most of all, you need insight. You need to understand what you're doing. And sometimes money doesn't always come with understanding. So for me, the answer is this, that in terms of what I want to see us do, particularly here in the Southwest and in Bristol in particular, is embrace the concept that there's no single organization or single unit that can actually deliver what a business needs. And there's an old saying, isn't there, that it takes a village to raise a child. And I think it takes an ecosystem to raise a business. And I would very much promote the concept that we need an integrated, partner-based, collaborative approach to supporting successful businesses. And we need to do it now, because at this moment in time, actually, I'm seeing the ecosystem in various parts of the country start to actually unravel for various sort of governmental approaches to how the business community is supported. And I'm not talking necessarily about those fabulous businesses, the real stellar businesses, the Dysons, the Arms, or whatever. I'm talking about those small SMEs employing somewhere between 10, 20, 30 people, turning over a few £1 million a year. These are the lifeblood of the UK. This is the lifeblood of the Southwest. And we really need to make sure we get behind them collectively. And it's not just the money, but it's all the other bits that go with it. We in Bristol, and I'll just talk about Bristol at the moment because I think we're all here or thereabouts. We have had over the last few years a fabulous financial, technical, operational ecosystem that exists to support business. And I think we should all collectively here make sure we put our weight behind ensuring that continues well into the future.
Okay. All right. Thank you for that, Paul. I'm going to go to Lydia now, and what your views are on this.
So my views, essentially kind of come into those that design the financial products, are ensure your products are relevant for migrant entrepreneurs that want to grow their business. I think relationship building to better understand the customer needs to happen a little bit more. We're very happy to help with that. And look at the migrant entrepreneurs as another market in itself. Adapt to the models that you have and market directly to them. Segmented products potentially, it already happens for different types of customers. Let's include the migrant community within that. Explain to your customers why your products are the right ones. It comes down a lot to marketing and communication, actually, my suggestions. Allow the entrepreneur to build confidence in your products and allow trust to be built in you as institutions. That's key. Create a product that supports organic growth aspirations. As I said before, people just won't go for large sums. People won't want to go from one branch of their business to 5, but they will go next year, they'll have another one, next year they'll have another one. It's got to be that organic growth, particularly for migrant communities, or indeed a blended approach. Create different packages that involve maybe loans, insurance, training, etc. Create different stuff, or stuff that's a bit more full and embodied, shall we say. I strongly believe, and I've seen the evidence of this, is that funds of less than £1,000 does unblock mobility quite significantly, particularly for extremely small businesses or micro enterprises when they are just starting up. That really does help. It also builds the behaviours in the entrepreneur around slightly riskier gearing, if you see what I mean with that. One thing that really does matter is representation. Diversify your teams, diversify your lending panels if you have them, and ensure people from diverse communities are featured in your marketing materials. I can't underestimate and kind of understate this enough. This is really big, and it comes down to communication. Show people that you want to work with them, show people that you want to do business with them, and that they are welcome within your institutions. And I 100% agree with Paul. I loved what he said about collaboration. Let us all work together. We all want to see the economy and the West of England thrive. Let's work together to do it.
And thank you, Lydia. I'm going to go over now to Paul Hamford, if you'd share your thoughts.
Yeah, sure. Thanks, Jordan. I guess there's a few things with regards to social enterprise. I think some of it is around, as Lydia mentioned, product design. And I think we will see more blended finance products. So, kind of part grant, part repairable loan going forward. We'll also think we'll see much more longer term patient capital, certainly what social enterprise needs, so much more flexible in approach than probably is available at the moment. Obviously, a lot of work we do is trying to get high net worth individuals to invest into social enterprise. At the moment, that's for a tax relief called SITR. That relief is due to be taken away by the government in April. So obviously we're campaigning at the moment for that relief to maintain, because that does allow high net worth individuals to get a relief on money, high risk money into enterprises that will need it. 25% of social enterprise that was surveyed back in June had less than 3 months income left. So there's certainly a demand for it. I think, just to build on what Paul and Lydia mentioned around sort of community, I think we're hoping there's going to be a lot more place-based investment, a lot more community investment. So things like community share offers, those kind of things, where actually, the community is kind of working together to get an asset, be that affordable homes or be that sports facilities. So we've seen slight growth in that during pandemic, and we've had some very successful raises, and I think hopefully that will continue. So again, I can work on this collaboration thing, but it's also about the community getting involved and investing in itself, if you like.
Right, thanks. Well, and then finally, John Field at Metro, if you'd share your comments.
Yeah, sure. I think for me, from a banking perspective, it's really what I want is the banks to continue to be supportive and work closely with their customers, basically, after these schemes fall away. So we know that the government support schemes are due to end, and that we, as bankers, we have other tools at our disposal, that we can offer and support customers with. We can look at various different things, such as interest roll up on loan facilities, increasing limits, waiving fees, capital repayment holidays. All these things we've done throughout this last 6 months. But it's not just about lending money. There are other things that we can do to take the pressure off customers. And I think as a community organisation ourselves, as a bank, we're key thing is being close to our customers. I just hope that after these schemes fall away, that the banking community in general will do their best to support and look at other ways of supporting customers.
Brilliant. Thanks, John. So getting quite a few questions through, so I'm going to zip around and ask as many as I can. First one that I've got through here, which links to a few of the other ones as well, is for Paul Jones at British Business Bank. We've got with 1.2 million T-bills and bounce back loans now in circulation. What's the likelihood of loan repayments being softened by government to ease the burden on small business in the future?
It's a very good question, and obviously a concern. When the schemes were launched, they were initially launched or thought to be launched on a 6-month interest-free period or interest paid by government. That was all increased to 12 months, which pushes us most of the loans into 2021 before repayments of interest and in most cases capital are due. That said, the initial thought that the COVID period would probably be only six weeks to 2 months, which has obviously gone on far further than that, and now we look at potentially a second lockdown, whether that's partial or full. Much of the country is already in partial lockdown. There is no conversations currently going on about doing so. Obviously, the complexity of 1.2 million loans shared across 100+ organisations with all different needs behind them. There is some conversation going on about how we can be consistent and how we can help and support the banks, but there isn't anything at this moment in time to suggest, as I think was in the question, a bad bank or removing that or softening the periods. But I think each case has to be taken on its own merits as we get towards that repayment point in 2021.
Thanks for that. Sorry, there's someone's drilling next door, so if you hear a drill come through my microphone, it is expected. I've just asked for a bit of clarity from Paul Hanford regarding the removal of social investment tax relief. Just wondering if you could go into that point again.
Yeah, sure. So social investment tax relief allows an individual high net worth to invest in a fund or into a social enterprise directly, mainly into a fund. So residents have got 2 funds, one in the Southwest, one in the West Mids. So this tax relief is due to go in April because the government haven't committed to it. So it's tax relief that unless they say they're going to extend it, will just go. So the current issue with that is that obviously we can't really get new capital in from high net worths because we may not be able to deploy the capital by next April. So on the government to make a decision on it. They may not say anything and just goes in April. We're currently campaigning with Big Society Capital at the moment for an extension to it. It's been minted that they may announce something in the next budget, whenever that is. But yeah, at the moment it's kind of a bit of a, unless we hear differently, it will go in April.
I've got another question in regard to Paul O'Collins' comments around an integrated system of support. So this is an open question to the panel. Do you feel that the government needs to bring in a general business support scheme similar to the Growth Accelerator programme that was successful a few years ago? I'll leave that open if anyone wants to pick that up.
Growth Accelerator certainly had its advocates and its critics, like every government support scheme and every business support scheme. For me, I think we do a lot of work with Scale Up Institute, and they have been for a long time talking about this concept of a village, effectively. And in a place like Bristol, where you have so many organisations who are able to provide all sorts of fantastic support to businesses, whether it's a university, whether it's a corporate, whether it's a social enterprise, whether it's a local local council. You know, it's just bringing it all together, and you know, it's an impossible job for one person to do on their own. But I think what I would like to see is less centralized delivery, but more convening of local organizations to actually support local businesses and helping them go forward, whether that through membership organizations or whether through cohesive collectives, I don't know. But I'm sort of a bit against sort of centralized programs of support, and do favor the concept of working with your peers and your colleagues for success. We're doing a lot of peer-to-peer networking just to achieve that very self-same thing.
Yeah, brilliant. Thanks, Paul. I've got another one, another question in to all panelists. Are the current levels of debt versus projected revenues in balance across the various sectors represented here, or is debt versus revenue high at the moment? If high, do you see businesses eventually trading out of a highly geared scenario? Who would like to pick up that one? Maybe I'll nominate someone, maybe John. Which one?
I think the reality is that some will and some won't, and I think individual lenders need to quite clearly work with their customers and provide them with the ongoing support that they need. And so, as with Metro Bank, we've introduced a much higher level of monitoring and engagement with our existing customers. So it's up to all of us to carry on doing that. But you know, I think we will find cases where the you know, individual customers are too highly geared, and that they need a longer term solution. And you know, there are mechanisms that are being explored currently. I don't know if that's something that Paul could talk a bit more about. But certainly that will be the case, that that ongoing intensive support will be required.
Did anyone else want to pick them out? I noticed you came off mute, John.
Yeah, I think that's absolutely right. I mean, you know, the CBILS credit process was very much a full and thorough you know, credit process, business as usual for us as a bank, which is why probably there was, you know, there were more CBILS applications not approved, because they were considered sometimes to be too, you know, and to not meet the credit profile. Bounce back, obviously a lot easier to get hold of, and yeah, I've mentioned it before. I think going forward we will unfortunately see some casualties. We will, because there have been instances of people just looking at the current situation and taking what they can, but maybe not focusing on the future and repayment of them. So, you know, there will be heightened monitoring. And you know, all banks anyway have teams already in house to work on that side of it. But yeah, it's about close working with the borrowers and making sure that a lot of this actually doesn't turn bad. But yeah.
Thanks for that, John. Just looking if we've got any more questions. Just a lot around the Financial Times announcement, but as Paul mentioned, there will be a formal announcement in the next 48 hours. So just no further from there. But if that's all that we have today, I think it's a good time to wrap up. 5 minutes before the close. So yeah, I just wanted to say thanks to everybody for joining us today. I don't know about you, but I've really enjoyed the discussion this morning. And a massive thank you to the panel for joining us. Really appreciate it and sharing your opinions. It's been really great. What I would say as closing words is please do get in touch if you'd like to work closer with SWIG. And also please get in touch if you'd be interested in working with us on different events like this into the future. You can make contact with us at info@swigfinance.co.uk, or equally just add me on LinkedIn. I'm Jordan Berg from SME Finance, Business Manager, and give me a little DM, and I'll be happy to connect with you. But thank you all again, and have a great rest of your week. Goodbye.